Hi everyone, Jeff Yasteen here. Make sure to hit the red subscribe button for our YouTube channel here and follow me on Twitter and on Facebook. Well, the sell-off that we've seen on Thursday and Friday, I think demonstrates a really great point, in my opinion, about investing and trading. And that is that sometimes, especially if you have a sense that a few key parts of the stock market or the sector you've been most interested in might be overstretched, as tech stocks have been recently, it's not a bad idea to look someplace else for counter trend ideas, away from that most favored area of trading for your investment in trading ideas. So that's a key reason why I've been focusing on stocks for you over the past month that are away from the technology realm. For instance, I said I really like the look of cruise line stocks in a video I did with Roger on August 13th. Now, nothing is guaranteed in this world. That's why we're in the stock market, not buying CDs. But cruise line stocks were beginning to creep higher at the time and without any real news. And no one really wanted to own them that I could tell. And in the last few days, what's happened? Well, we've had news about vaccine rollouts for November, and Carnival is also looking to restart its cruise line operations in Europe for the first time since the pandemic. And the spike that we've seen in Royal Caribbean gives us a gain of around 18 to 20% or so, and for Carnival around 15%. Now, these are not stocks that are going to double in a month. They're not Tesla type stocks, but I think they could double in a year. And a year from now, think about it. We presume that vaccines will be relatively widespread for COVID-19. Not only that, but both companies have new ships joining their fleet. And that's always good for getting new people in the door as well. Most importantly, the cruise lines are in the process of paring down their fleets. Now, what happens when you have rising demand but a smaller amount of supply? In this case, the sleeping berths where people go, where we all go. If you take a cruise, you got to have someplace to go to sleep. Well, ticket prices have to go up in that sort of case. It's the same thing that we saw in the airline industry after the 2008-2010 financial crisis, when so many airlines were having serious financial problems. A few went into bankruptcy, and that bankruptcy allowed them to get rid of some of their planes. And because of that, you have fewer seats available in the fleet, and therefore it keeps ticket prices higher because you have basically less supply, but coming out of the financial crisis, rising demand. And I see the same thing happening here for cruise lines as they get rid of these oldest ships that are in their fleet. And frankly, this is something that stock market analysts have been complaining about for both Royal Caribbean and Carnival for some time now. And I think now that they move those ships out and get them to the scrapyard, essentially it clears the decks, if you will, to use a nautical metaphor, and allow higher ticket prices, which should help their margins as well. Now, I think there's another lesson at work here for us, anticipation. When stocks move higher over a period of days, weeks, or months, they're anticipating future events, future headlines. So in the case of the cruise line stocks, the investors causing those shares to spike over recent days are the ones coming to the game late, if you will, and they're forced to pay higher prices to buy into the same trend that I identified for you 3 weeks ago. So keep saying that to yourself. The stocks move higher or they can move lower in anticipation of future positive events, or in the opposite direction, to negative events. Now, also, I said I liked airline stocks in a video a week and a half ago for similar reasons, and those stocks are up around 18% or so since the start of August, and since up about 50% since the lows in March. And I think we'll see more gains there in that sector as well in coming weeks. Now, another stock or set of stocks that I said I liked was insurance and banking, specifically Aflac. Now, the bank and insurance stocks have not started to really trend up in a big way, but they're holding their own in the downtrend that we've seen in the broader market over the last couple of days. And I like that. Anytime a stock can hold its own in a weak overall market environment is a good thing. And I expect those stocks to continue to work their way higher over time. I also said I liked a pair of drone stocks. One was Kratos Defense and Security, KTOS. The other is Raytheon Technologies, RTX. Setting aside the growth of the emerging drone economy for a moment, both of those companies are in the defense sector. Now, that's another part of the stock market that has been generally ignored by investors because everyone has been so fixated on technology and the sort of stay-at-home stocks. So again, anything that does well, holds its own in a weak market, as defense stocks have done, is a good idea as well. So again, all this just points out why it's something you have to think about when it comes to perhaps chasing the same ideas as millions of other investors. It's a tendency that we all have, is to go after the same things everybody else likes. That's the reason why things like social media exist in the first place. And it's the same on Wall Street as well. I mean, imagine how unpopular you'd be, standing in front of a mutual funds investment committee and saying, I like cruise line stocks, when no one in their right mind, in terms of your peers, is buying cruise line stocks. Your committee would say you're crazy, and you'd be out on the street looking for work. But as individual investors, we can stake out other kinds of positions. We can stake out other opportunities. We don't have to worry about a committee looking over our shoulder. On Wall Street, you stay with what works until it doesn't. We saw a good example of how that can sometimes wind up late last week. The thing to remember, Wall Street, the biggest portion of their paychecks comes from assets under management, gathering up money from investors rather than the actual performance of their investments. The problem is, sometimes with that kind of scenario, it creates rallies that become so extended, they become prone to a big sell-off like we saw, even if it's only a temporary collapse. But, if you're a latecomer to one of those rallies, guess who's left holding the bag with nothing but losses? You are. So consider the sell-offs that we saw last week as a warning shot on the dangers of following, millions of other like-minded investors into the same rally, the same stocks. So when everyone else owns the same set of stocks, there are progressively fewer traders left to take the other side of the trade. So when everyone finally decides, millions of investors decide they all want to get out of those stocks at the same time, what happens? The share prices plummet as they all, rush for the exits. So keep that in mind as we go forward here, because I expect that we will see a rotation out of tech stocks into other stocks that have not really participated much in the rally. And I've identified some of those for you in the last handful of weeks. And I think if we continuing to keep our eye on other kinds of opportunities that have not yet been fully recognized by the mass of investors out there, we can continue to notch nice gains, as well as continuing to continue with the momentum that we've established in the last 4 weeks or so, identifying these sort of ignored aspects of the market. So if you like what I'm talking about, make sure to follow me on social media, subscribe to us here on YouTube, and I'll talk to you later. I'm Jeff Yasteen.